Thanks for coming back, despite what happened the first time. Let's take what we've learned and apply it in finance. And so this part of the talk, I'm going to tell you about what some people have done, but I'm also going to try to give you some suggestions, based on my reading of the literature, about what needs to be done. Because I think that the theory of rational intention has made great progress in the last 10 years. In some places in finance, it's starting to be applied, but in other places, it has yet to be applied, and I think there are interesting opportunities if you're interested in working in this area. So, as we discussed, there's sort of three things that we really know how to do with rational inattention. We know how to solve binary choice problems. We know how to solve linear quadratic Gaussian problems. And we know that with mutual information, we end up with logit choice. And those are kind of the three things that we know how to do very cleanly. Let's think about that in the context of finance. So one place we can operate is binary decisions, yes or no. You might be offered to buy a security at a price, and then you have to decide yes or no. So that's going to be Ming Yang's paper, job market paper, which I think is published or is about to be published. You might also decide whether or not to run on your bank or engage in a George Soros-style speculative attack on a currency. That's been traditionally modeled as a binary decision in what is called a global game. So Ming Yang 2015 and Morris and Yang and then also Tommaso Denti's job market paper consider rational inattention in that context. Yeah.
So if you do model it as a global game, your optimal decision becomes independent of what other people do. But if you don't, then it's more complicated than just a binary decision because you have to take into account what the others do.
Well, so in these kind of papers, you still have a binary decision, run or don't run. There's no quantity or intensive margin.
It's not going to just depend on your...
Well, your payoff will depend on what everyone else is doing, and what everyone else is doing may or may not be related to the fundamental, and things are going to get ugly, and I'm going to drag you through that ugliness. So that's going to happen. Linear quadratic Gaussian settings, a very natural place to start is portfolio choice. The theory of Markowitz started with mean variance optimization. So Van Nieuwenburg and Veldkamp were sort of the originators of this literature. I'm going to tell you about some of their papers. Mondria is a nice contribution that's related to that. So this is something that is happening, but largely this linear quadratic Gaussian stuff has been done in more of a macro context. And I won't be telling you about that as much. But I will point out that I think there are probably other settings in finance, aside from portfolio choice, where thinking about mean variance makes sense. And I don't think those have been totally explored. Discrete choice logit, as it applies to finance, I have not seen any rational inattention papers. I think this is actually a major oversight. So there are people in finance who are doing things with discrete choice and logit. So Ralph Koyen and Moto Yogo have a nice series of papers about insurance companies, and actually more recently about sort of general demand curves in asset markets, where they take logit choice as the primitive. Mark Egan, Ali Hortaksu, and Gregor Matvos are sort of doing like I.O. with banks. But like many other papers in I.O., they're using discrete choice. And as I mentioned earlier, these authors give sort of a random utility type interpretation to what they're doing. But I think there's interesting possibilities for giving it a rational inattention interpretation and then trying to explore how that changes things vis-a-vis optimal policy or regulation or welfare. I wish I could tell you about this stuff, but I don't think anyone has done it. I will mention that my job market paper in the appendix, not even in the main part, has a little bit of an application that uses some of this to contracting or moral hazard settings. But again, I think that this area is underexplored. One thing that has been quite explored is sluggish expectations. So Euron, I think, will tell you a lot more about expectations. But usually in these papers, there's a reference to a rational inattention model, but not a formal rational inattention model. So I'm not really going to tell you much about this. I'll just sort of tell you the results, which is that in rational inattention models, expectations move sluggishly, and sometimes that's what we see in the data. And leave it to Euron to tell you more about that. One of our Stanford finance PhD students who was on the job market this year, Jay, has a nice paper where he kind of takes this idea and thinks about it in the context of bond trading. And this actually involves data. This is mostly an empirical paper. To my knowledge, it is really the only paper that I think gives a very compelling evidence for something like rational inattention in a financial market. And so at the end of the talk, I'll tell you about this paper and what he finds. But it's related to this sluggish expectations idea. Okay, so are there any questions about where we're going, what we're going to do? All right. So let's start by thinking about buying a security. So Woodford 2009 is the original paper about binary choice with rational inattention. Ming Yang sort of independently developed some of that and then applied it to the setting of buying a security. And then I'll tell you a little bit about an application of some of the stuff that I've done. So here our state space, now we're doing applications, is going to be a set of possible asset values. So think about a mortgage-backed security. The X here is the value of the loans that underlie the security. The rationally inattentive agent is offered a security V, which is a function from X to a positive real at a price K. The security satisfies limited liability. What that means is that the value that it will offer this agent is at least 0 and no more than the underlying value of the assets. The buyer, the rationally inattentive agent, is risk neutral, and her actions are either to buy B or not buy N, the security. And then just to normalize things, if you don't buy, utility is 0. So this is a binary choice rational inattention problem. So the general problem, subject to that Bayes consistency condition, is to maximize your expected utility minus your information costs. That's just the general problem. Here, our actions are just B and N. Our utility, if we buy, is the security payoff minus the price. If we don't buy, our utility is 0. I'm going to use as notation iota to mean a vector full of 1s. So the first order condition is that my utility of buying, technically minus my utility of not buying, but that's 0, is equal to the difference of the gradients of my cost function when I buy or when I don't buy. This is provided there's an interior solution, meaning I might buy or might not buy. There's always a chance that I will just reject, and there's always a chance that I will just accept. And that depends on these things. And so if, in general, the K is really big relative to the V, this whole thing is going to be negative. In fact, you can see that if the K was bigger than the maximum value, remember that a divergence is always positive, this thing has to be negative. I will reject if the price is bigger than the highest value of the security. That's obvious. Turns out I will also reject if the price is less than the highest possible value, but the security is still sufficiently a bad deal under my prior. Similarly, I will always accept if the security is likely to be much bigger than the value than the price.
Just a question about the setup. You described this as buying a security, but if V of X is just my utility for some good, I'm buying a bottle of wine. The quality of the wine is unknown. Why isn't this buying wine or
well, I think what we learned last night is that art
well,
is sort of like a security. Maybe wine is like a security.
Well, but here we're just
Oh, here you're going to drink it.
we're
I
not
see.
going to sell
Yeah, no, not.
anything we consume.
This is buying something at a price.
Right.
There, now, what's going to happen, the fun part, is that after we solve the model for will I buy it, we're going to take the perspective of the seller and start designing this V. And then it will have more of the meaning of the security. Yeah.
So this is the interaction, so it's not a problem in finance. What is the puzzle you're trying to address? What's the empirical regularity that your model hopefully will?
Well, so first off, I did not write this paper, but the author. Well, so what I'm trying to do is illustrate how you can apply this theory. When we do that designing the V part, the question we will be asking, remember, the buyer is acquiring information and choosing to buy the security or not. From the seller's perspective, there's a name for that, which is adverse selection. Because the buyer is going to buy it when the buyer thinks it's a good deal and not buy it when the buyer thinks it's a bad deal. So this is an adverse selection setting. And the question that Ming Yang was originally asking is, what is the optimal security design that avoids adverse selection? And so that, I think, is a very well-defined finance question. And I will show you his result is that the answer is a debt security. And we'll try to understand why. Yeah?
Wouldn't the seller also like to design the cost function of the information?
Would like to, probably, in terms of preventing the buyer from acquiring this or that kind of information.
Wouldn't you require as much as possible to deal with adverse selection? I don't know.
Well, yeah, so you're being adversely selected against. You don't want them to have information. Here, information is bad because it's an endowment economy, right? The only and it's going to be efficient to sell. So the problem is that sometimes we might not sell. So we generally don't think about this as being a choice. We think about it as being exogenous. That said, there is this literature on information design that Stephen Morris and others have been working on, which is very much about that, where they take these payoffs as given, and they're trying to design the information environment. That's a bit outside the scope of what I'm going to do. Okay. So given any security V and a price, there are critical thresholds, K, such that I will always buy if the price is less than KB, which depends on the V, and never buy if the price is more than Kn. In the interval in between, I will buy with some probability. So I'm more likely to buy when the value of the security is above K than when the value of the security is below K. Let's prove that. That sounds super intuitive. It's easy to prove. What am I going to do? Well, I'm going to take, this is essentially my first order condition, and I've multiplied it by Q buy minus prior. Remember, this is my posterior if I buy. This is my prior. That's my first order condition. This is the other side of my first order condition. Now I've multiplied it by that divergence. I've multiplied it by that divergence. These things are convex, and the definitions of convex functions lead me to conclude that this is positive, strictly if QB is not Q0. The QB equals Q0, what would that mean? That would mean that I am indifferent under my prior between buying and not buying, and I'm just randomizing. So that's an edge case. So the buyer is more likely to buy when the value of the security is high than when the value of the security is low. That's bad news for the seller who is being adversely selected against. So the seller has three options to deal with this adverse selection by the rationally inattentive buyer. You can tolerate it, just say, well, okay, he's going to do it, can't stop him. I'll design the security as best as I can. You can not sell. It's one way to avoid adverse selection is not to sell. Or you can offer such a good deal that they won't gather any information and just buy it. You've avoided the adverse selection, but you've paid a price because you're essentially bribing them not to adversely select. So that's also costly. Okay, so let's suppose that the seller likes the security less than the buyer by some discount factor. This is the normal way of motivating trade in these models. And we're going to do the first order approach in security design, completely ignoring the various possibilities of that not working. So if the seller tolerates adverse selection, that is, he's going to assume that the buyer is going to adversely select, we can think about the seller as choosing a security and a price, and also the buyer's posterior, because remember, this is the first order approach. The principal chooses the agent's action. To maximize the seller's payoff, which is the price minus the discounted value of the security, subject to the first order condition of the buyer, which is the constraint in the problem. So that's what I mean by first order approach. Hopefully you've seen this before. Principal maximizes her objective function over choosing also the buyer's action subject to the constraint of the first order condition of the buyer. The nice thing about this environment is that you can show, although I am not doing so on these slides, that this is okay. That is that the first order condition does indeed uniquely pin down the buyer's optimal action, and so the first order approach is valid. If the seller wants to avoid adverse selection, you have to solve maximizing your payoff. Now notice the difference here. Here, the seller only gets the payoff if the buyer buys. Here, something different is happening. The seller gets the payoff under the prior because the buyer is just agreeing without gathering any information. But it's subject to a complicated incentive compatibility constraint that says I need to pay the buyer, I need to offer the buyer a good enough price to avoid the adverse selection.
What makes the problem like this is exactly the discount factor that reduces it to that in that case, right? It always changes, it must be changing hands.
Yeah. Right, well, so here it doesn't always change hands.
Yeah, but down here.
Down here it always changes hands, but I have to bribe you. The grand problem is to max over these two things, right? Because the seller can decide, either I'm going to tolerate adverse selection or offer a good enough price to completely avoid it. Both of those things are possible as optimal strategies. I will say this problem, because there's like a max in the constraint, it turns out what you want to do is work with the dual, but I'm not going to drag you through that. We'll focus on this problem. Okay, so with the Kullback-Leibler divergence as our cost function, that is mutual information, the optimal security design is a debt. And what debt means here is that the security is the min of the underlying asset value x and some constant v bar. So it's a hockey stick. Up, flat. This turns out to be true in both of those problems. That is, regardless of whether we are tolerating adverse selection or avoiding adverse selection, in either of those problems, debt is the optimal security design. Yeah.
So yesterday we had Ilan Kramer here, and he was looking at the dual problems. So he was thinking about the case of a manager that needs finance.
Mm-hmm.
And it turns out that the problem, as you get make the problem more complicated, that's not true. But the first answer, the simplest problem is again is debt,
Yes.
right? In that framework. So it seems that it's really hard to get that not to be optimal. You have to put a lot of bells and whistles.
Well, actually, so I will show you one where it sort of doesn't work out. So Dan Gordon.
Also did, but
Yeah.
But you need bells and whistles.
I don't think that's totally how I would characterize it. But so Deng Gorton Holmstrom is exactly Ming Yang's paper, with one difference. Instead of rational inattention, you buy a signal or you don't. That's the choice. Is that binary information acquisition. Exact same problem. What happens in that paper is that, again, you find debt is the optimal security. But there are other optimal securities called quasi-debts. See if I can draw a picture. Is there a marker here? No. Okay. Oh, it's all right. A quasi... Here? Oh, yeah. All right. Excellent. So a quasi-debt. Here's debt, hockey stick. Here's a quasi-debt. Oh. Up. This hockey stick is up, flat. Everything flat. A quasi-debt is everything averaging to flat, but anything, sine wave, whatever you want here, as long as it averages to flat. Why do you get quasi-debts in Deng Gorton Holmstrom? The answer is that with a binary information choice, all I care about is expected values. Anything that has the right expected value, conditional on the signal I can receive, good to go. With endogenous information acquisition, like rational inattention, that is flexible, you could get a signal about whether you were on the bottom or the top of the sine wave. So, in some sense, this problem with the binary information acquisition is unbalanced. What do I mean by that? The V lives in a high-dimensional space. It's a vector that is whose dimension is the dimension of our state space. A binary information acquisition lives in a low-dimensional space. A one-dimensional information acquisition, like say you could get a normally distributed signal, lives in a one-dimensional space. Low dimensionality for the agent and high dimensionality for the principal generates weird stuff. But in rational inattention, the Q hat lives in the same kind of dimensionality of space as the V. The agent and the principal have tools that are of the same dimensionality, and that pins down solutions uniquely. And this is sort of a recurring theme in the security design literature. It's easy, as Jose says, to get debt when you have 2 or 3 states in your model. But when you go to a lot of states, but you only give your agent one dimension of actions, you start to get crazy-looking securities. And the reason is that there's this lack of balance. So more flexible information acquisition puts the security design problem and the information acquisition problem sort of on equal footing. I show that this idea extends to my proposed alternative cost function. Debt turns out not to be optimal, but the thing is sort of debt-like.
But then exactly the same problem that you described what do you mean by that? Like,
So
it
the,
only works for the proof by light that I heard.
yeah, so with my proposed alternative, it turns out that the optimal cost function is like everything and then flat, but it jumps down. If you restrict to monotone, though, it ends up being dead. That's a common trick in the security design literature.
You said you get a little bit more flexibility with it, or you get some other stuff we never observe, right? We never observe we could get a non-monotone payment, but once your firm issues a color option or a digital option of some kind, under that you don't see those, right? Most securities that firms issue have this monopolistic one. You get more money than the firm does better, or at least not less money.
Yeah, so there's something missing from the model about why that's a good idea.
It's really hard to get, but it's the point I was trying to make, either from one side or the other, it's really hard to get out of debt, unless you introduce specific costs of debt, like bankruptcy costs.
Well, I don't.
Something that makes debt particularly expensive.
I don't know. Like, so in Gabe Carroll's model, for example, equity is optimal, not debt. Right?
Yeah, models get those things, but I don't know what he's doing.
Oh, so it's a different consideration. It's that essentially, I don't want to take us too far away, but what I show in my job market paper is that debt is sort of a good balance between avoiding low effort and avoiding risk shifting. If your only concern is avoiding risk shifting, then equity becomes optimal. So there are, yeah.
If you would add the condition of monotonicity, you would get that, right?
If you add the condition of monotonicity, you would get debt. Yeah. Because it has to average, and if it can't, yeah. So whether or not monotonicity as a constraint makes sense or not, people have argued about. I will just point out that there are nice results that happen when you sort of have the agent have as many degrees of freedom as the principal. Yeah.
Can you give us an idea of your alternative and or why you have this jump down?
Yeah, so why do I get this jump down in the alternative that I propose? This is taking us a little far afield. It turns out that the level here is the expected value of the security. So when you set that level, you avoid any kind of adverse selection here because the agent is totally indifferent. Now, in my proposed alternative, you can't sharply discriminate between states. So having this giant jump is not very costly. So it sort of averages out in this region, and it works out. If you gave this security to a mutual information agent, they would get a signal that was very sharp at this point, and then adversely select against you. So the inability under my alternative to get sharp signals is what allows for that discontinuity. Okay, so that's Ming Yang 2018-19, I forgot. Security design with rational inattention. Let's do a different kind of binary choice problem, which is about global games, speculative attacks or bank runs or what have you. So a continuum of mass 1 of rationally inattentive agents are going to decide to run or not run. Their actions are R, run, or N, not run. And let little r be the equilibrium mass of agents that are running. There's going to be strategic complementarity. So what do I mean by that? Well, the state X, which is the fundamental, turns out to be the threshold that triggers regime change. So you want to run if enough other people are running to trigger regime change. And you do not want to run if there are not enough other people running to trigger regime change. Obviously, if x is less than 0, running is going to be dominant. If x is greater than or equal to 1, not running is going to be dominant. But for x between 0 and 1, it's coordination. Now, this setting is sort of the classic global game, but in global games, people have traditionally studied exogenous signals and looked at the limit as the noise in those signals goes to 0. And the classic finding there is that there is a unique equilibrium that is selected, which is known as the risk-dominant equilibrium. So there'll be one cutoff of the fundamental. If it's above that, people will run. If it's not above that, people will not run. If you introduce common noise, then things get more complicated, but in ways that I don't necessarily want to belabor. Okay, so to study a rationally inattentive agent in a game or a market, we need more assumptions. Everything we've done up to this point has been one person making a decision problem. But now we have lots of people. So we need to decide what can you learn about and how your errors are correlated with other people's errors. And without making a stance on these two things, we're not going to be able to say anything. So Ming Yang takes the following approach. You only learn about the fundamentals, the X, and you have IID errors across the agents. We'll see Tommaso Denti takes a different approach. We'll see that in a little bit. Okay, so let's try to construct monotone equilibria. We're going to have lots of people running more than the fundamental, if and only if, yeah.
So what would it mean to learn about something other than the you mean
Well,
learn about other people's?
What we'd really like to know is R. We'd really like to learn about other people's equilibrium actions, because it's a coordination game. But if you only let me learn about the fundamentals, then I have to rely on what I think is the map between the fundamentals and the aggregate action to infer things about the aggregate action. But what I'd really like to know directly is what is R. That's what I'd like to learn about.
You'd like to know about X too.
Or R minus X would be the sufficient statistic. So,
I mean, what is the setup of people choosing simultaneously?
well, right now, we don't need to worry about that because we're adopting the Ming Yang approach.
Yeah.
When we talk about the Tommaso Denti approach, we're going to talk about that. So we're going to think about monotone equilibria. People will run enough to change the regime if and only if the fundamental is bigger than some cutoff. We're going to assume the prior over the states is continuous in the CDF and symmetric about x equals 1/2. The symmetric part is just going to make my formulas easy. It's not important. The continuous CDF part just means there's no atoms of probability. That's going to make life easier as well. So for example, uniform over some interval that contains 0, 1 would be a nice choice here. But anything with this is going to be fine. Okay. So we have actions run, not run. Our utility is 1 if we run and enough other people run, 0 if we run and they don't run, 1 if we don't run and no one else runs, 0 if we don't run but everyone else runs. Assuming interior solutions, so again, assuming mixed strategies, the FOCs are going to be the same binary choice thing that we've seen before. The only thing that's different is that in the last example, I called it B for buy. Now I'm calling it R for run. Same first order condition. Same always run, never run conditions. Using the logit formula with mutual information, we get this nice expression. The thing about binary choice is that the probability of not running is 1 minus the probability of running. So I just have that pi r nuisance parameter. But this is my logit choice. The probability of me running conditional on x is in this conjectured equilibrium low if x is less than x bar and high if x is greater than x bar. So let q x bar be our prior probability that x is greater than x bar. Our pi r solves kind of an ugly expression. This is the equation that pins down the pi r. To make the equilibrium work, what we need is that the probability of running if, let me make sure I get this right, there might be a sign error here, but if everyone is, to make this work as an equilibrium, if x is bigger than x bar, I need the probability of an individual agent running, using the IID assumption and the law of large numbers, to be higher than x bar. Otherwise, I'm not going to get regime change. Similarly, if x is less than or equal to x bar, I need the probability of an individual agent running to be less than x bar. Otherwise, I will get regime change when I don't want it. So in order to construct this x bar equilibrium, I need my x bar to live inside this interval. And of course, the pi r is pinned down by this equation. So really what I'm asking is, well, if I solve this equation for pi r and then plug it in here, can I put the x bar there? But remember that the x bar is going to determine the q of x bar. So I have to sort of solve these two equations simultaneously. So, but let's make an observation. If x bar is 1/2, right? That's where I assumed the PDF was symmetric, about 1/2. Then q of x bar is 1/2. It should be obvious to you that the pi r in this case will be 1/2, right? Why? Well, if we're right at the regime change threshold and it's 50-50, my optimal behavior should be to run half the time and not run half the time. And this condition that we needed for existence is strictly satisfied. So remember, this thing had a bunch of pi r's, but they're all 1/2. So now I've simplified it. You can see e to the number over e to the number plus 1 is bigger than 1/2. 1 over 1 plus e to the number is smaller than 1/2. We're good to go. But this interval is wide. In particular, in any kind of neighborhood around x bar equals 1/2, we're also going to be able to satisfy these equations. Consequently, there are multiple x bars that are going to work here. And we have multiplicity. Now, let's take the limit, because remember, in the global games classic analysis, you take the limit as the noise goes to 0. In rational inattention, we have our theta parameter. Our theta parameter, if it goes to 0, what that means is that the information is becoming almost free. Consequently, it's like taking the noise to 0. So let's take our theta to 0. When we take our theta to 0, this thing is going to become a very wide interval. This will go to 0. This will go to 1. And all we need is basically that x bar lives in 0, 1. That is, it's not in the dominance region. So let's take a step back. Remember, the whole point of this global games business was to get a unique equilibrium. And what I have just shown you is that with rationally inattentive agents, we're back to the full information set situation, in which every monotone cutoff that is not in the dominance region is an equilibrium. So something about the global games assumption of the exogenous information really made those agents behave differently than they would if they could choose their own information. Something about endogenously choosing your information was really, really important here. And let's figure out what's going on. The key idea is that in these monotone equilibria, what you want is a binary signal. X bigger than X bar or not. That's what you want. That's the monotone equilibrium. With exogenous information, you don't get that. You get like a normally distributed signal or something like that. Not what you want. But with mutual information, you're going to choose this signal. It will be noisy. Sometimes you'll be told X bigger than X bar, but in fact X less than X bar. It's not going to be perfect, but it will be discrete and binary. Consequently, you're back to the multiplicity. Everyone can coordinate their signals on an arbitrary X bar threshold. As those signals become more and more precise, it's all going to work out. However, this depends on it being very cheap to get a signal that discretely changes probabilities at x's that are very close to each other. Remember that that is what I don't like about mutual information. So what Ming and Stephen Morris show is that with any cost of information that guarantees what they call continuous choice, meaning you can't jump your signal, you do get uniqueness. But with mutual information, you don't get uniqueness. For example, with the proposed alternative that I have, you do get uniqueness. Yeah?
Can we think of it as saying that this threshold is actually meaningless with mutual information? Because all you want is something that tells you sometimes you should go up or run or don't run. But the location of it really has...
Exactly. The location has no intrinsic meaning to the cost function.
And this is how you get
So you can coordinate on anything. That's right.
So what is the cost function of Lewis and
They don't use one. They say, here is a property, continuous choice, such that if this is satisfied, you get uniqueness. And if it is not satisfied, you get multiplicity. So they're not proposing anything specific. They're saying, this is what must be true. Okay. But now, let's do something a little more complicated. This is getting to Elhanan's question earlier. What happens if you can try to learn about the R? Now we need to be a little bit precise. Okay. So the first thing we're going to do is, in the previous version of the model, I considered an infinite version, infinitely large number of agents, and invoked the law of large numbers. It turns out that that might have been a little bit of a mistake, or at least going a little too fast. So let's do a finite agent version. Now there are M agents. M can be very large. Doesn't matter how large it is, but it's going to be finite. Following Tommaso, we're going to think about each agent trying to learn about R not I. R not I is what everyone else is doing. Tommaso imagines this as a sequential thing. So this was Elhanan's question. Today, I wake up, I learn what Eric and Elhanan are doing, I choose my action, I go to sleep. Tomorrow, Eric wakes up, chooses his action, goes to sleep. Then Elhanan wakes up, chooses his action, goes to sleep. We keep going and going and going until we have settled on actions and are no longer changing. And that's his notion of equilibrium. So that's the kind of idea here, is no one wants to change given what everyone else is doing.
And each time you wake up, you find out something about what the others
I can use my information gathering technology to learn either about the fundamental or about what you two are doing. But both of those things are things that I can do. And we'll see how that works in a second.
What we plan to do at that day?
At every stage, when I'm awake, you have a probability of doing an A, right? So you are doing an A, or either run or not run. Eric is doing run or not run. I wake up, I see that Eric is running and you're not, maybe, or I can at least get a signal about that. I can also get a signal about the fundamental. I choose whether to run or not run. I go to sleep. Now Eric wakes up. He sees that I'm running and you're not running. He gets to maybe get a signal about that. He doesn't see it perfectly. Then he updates.
But we're not actually getting any payoffs from these choices.
No, until we all are locked in and we have our final equilibrium, nothing happens.
So is it as though we don't know when the game is going to end, and so we pretend that this is the last period? I mean, what is our maximization problem?
So, literally what you do is you solve a rational inattention problem.
But what's the objective function?
So the objective function is, as you say, I think that there's some stochastic probability of this being the end of the world and some probability of not, and then we look at the limit as that stochastic probability goes to not.
So we behave as though this is the end.
Yes. Now, you don't have to think about those dynamics to do this, and I'll show you that. So each individual agent takes R not I as an unknown part of the state space. So for an individual agent, your prior is a prior on the fundamental states jointly distributed with the R not I. Yeah?
When you take these actions, you take into account that you're going to be observed by a bunch of rationally inattentive guys that probably need something.
No, you don't take into account that your action will be observed. Well, no, that's not quite true. You know what? I don't want to answer that question. In the game in the dynamic game that we just talked about with Eric, you do take that into account. In the limit, it doesn't matter. So I want to set that aside. So the way I want you to think about this is that I have a prior, and the prior consists of both the fundamental state and what other people are doing. With mutual information, we still have logit. So now I can choose my probability of running. And now there are three possibilities. The first is that even if I run, not enough people will be running. The regime won't change. In which case, I'd try to, not run. The second possibility is that if I run, the regime will change, and if I don't run, the regime won't change. I am the pivotal player. In this case, I'm actually indifferent about what I do. Consequently, there's no reason for me to get any kind of information, so the probability that I run will just be the unconditional probability that I run. In this case, the regime is going to change no matter what, and therefore I would like to run. So I'll do so with a higher probability.
So again, I'm a little bit confused by the answer you gave to Eric. I just want to understand what's the problem I'm trying to solve. So we're learning is M the actions of the other agents?
R not I, is the actions of the other agents, or a sufficient statistic of the actions of the other agents.
That you think is given.
You have a prior over what that is. You can try to learn about it. You can try to learn about X.
Right, so that's part of what you're trying to learn about. So in a sense, it is about, are you going to run in the future if I run, or they ran and I don't?
No, think about their actions as being fixed.
So they ran or didn't?
They ran or didn't run, but you don't know.
I don't know if they ran.
And what you're trying to do is find out.
Okay. That's the problem.
But I don't understand. You were learning about Eric's action.
Sorry?
I don't understand the timing here. You are learning about Eric's action. That will determine what you want to do.
Yeah. Then I'll go to
At
sleep.
the same time, he can learn about
Well,
you.
don't think about it as,
At the
in
same
this
time,
kind
he
of...
can learn about you.
No, stop.
There's this dynamic.
There's this whole dynamic thing that justifies this as an equilibrium. You're welcome to read Tommaso's paper if you're interested in it.
We wake up sequentially.
Exactly.
Look at what the other people did in the
Not really
previous
look
round.
at what they do. We try to figure out
Well,
what they
Yeah.
you look at them indirectly. through the
Indirectly,
signal.
yeah. Okay.
But again, that's just a tendency. You are not yet running. You are planning to run.
Exactly.
Because the running is only at the end.
Exactly.
Running is at the end. You are planning to run.
So what you're doing, there's a bank, you think there might be a run. You're sort of thinking, well, do I get in my car? Do I see other people getting in their cars to go to the bank or not? You're kind of looking around. You're trying to watch what other people are doing. They're trying to watch what you're doing. At the end, there will either be a run or not. And this is a way of modeling that. So we have our same probabilities. But now we have to think, okay, there's an equation that pins down pi r. It's essentially the same equation that pins down the pi r, although now we have to account for this third possibility. So let's define equilibrium here. A symmetric equilibrium is a joint distribution of everyone's actions and the true state, such that the marginal on x is consistent with the exogenously given prior, and the best response for agent I, given a prior on the marginal here except with respect to own action, is consistent with this distribution. So it's a complicated equilibrium definition. But what it basically boils down to is that I have a prior about what all of you are doing and the fundamental. And then I'm going to generate my own rational inattention problem that's going to create probabilities. And those probabilities have to be consistent with this joint distribution. And that's the definition of equilibrium. Now, an observation here. Because we have finite, this should say m. This is m. I apologize. Because we have finite m, our prior here cannot be degenerate. So remember, in the previous example, we had a continuum of agents. We had an infinity. If x was bigger than x bar, regime change with 100%. If x was less than x bar, not regime change, 100%. Here, nothing happens with 100%. There's always a chance, even if all of our signals are independent, that we all screw up. It's a tiny chance, but it's a chance. Consequently, you don't really want to learn only about x. You also want to learn about r. Just knowing about x doesn't perfectly tell you whether the regime is going to change or not, because we don't have that infinite number of agents. So what Tommaso Denti shows is that in this framework, only the risk-dominant equilibrium survives in the limit as information becomes free. So we're back to the global games result. And the intuition here is that what you want is x minus r. If we only let you learn about x, we're not letting you get the signal you really want. And that's creating a sort of strange kind of coordination problem. But if we let you learn and just watch what other people are doing in this global game, then what you're going to try to do is coordinate with them. But there's always some uncertainty about that, and that's why you get the risk-dominant equilibrium.
And so what are the assumptions on the cost function here?
Mutual information.
So even in the mutual information case, presumably if you made the sort of Morris-Young...
Yeah. The Morrison-Yang thing, you got uniqueness even without letting people learn about what other people are doing.
And so this is only going to reinforce that, presumably. I mean, if you use their cost function here...
Yeah, so in Tommaso's thing, it doesn't matter what cost function you use. So the main exposition is mutual information, but it turns out that any cost function will do it.
Oh, I see. Okay.
So if I'm letting you learn about what other people are doing, and you take the limit as information becomes free, you will always get risk dominance. But if I don't let you learn about what other people are doing, then the cost function matters, which is sort of interesting. And the theme that I want to reinforce here, sort of, again, we're seeing how rational inattention is all really about letting the agents acquire the information they actually want. When you give them exogenous information, or when you limit what kinds of information they can acquire, you might be fundamentally changing the problem because you're not letting them get the information they want. Okay. That issue, letting them get the information they want, turns out also to appear in multivariate linear quadratic Gaussian settings. So one leading rational inattention linear quadratic Gaussian setting is portfolio choice and equilibrium in a Grossman-Stiglitz style model. And here I'm going to build on Van Nieuwenburg and Veldkamp 2009. So the questions we can ask in this kind of setting are things like, how does comparative advantage in information gathering affect risk share? Or what kind of information is or is not incorporated into market prices? Or do agents specialize information gathering where they learn a lot about one asset? Or do they try to be generalists and learn a little bit about a lot of things? What kinds of information will they be in?
The first question, isn't that very similar to the first question?
Well, this is saying different agents, how does their differences change who learns about what? Obviously, if all of them are completely generalists, the answer is not at all. But even in a world where everyone is the same, you could still get everyone specializing in one thing and learning nothing about the other thing. So they're different. But yeah, I mean, these are all related questions. And more generally, just what kind of information will agents focus on and what will they ignore? So suppose there are n risky assets and one risk-free asset. And now our action A is going to be a vector in Rn, which is our asset allocation. So asset payoffs are going to be normally distributed. The F here is the payoff. Mu x is the mean. Sigma is the variance-covariance matrix. This is of the risky assets. And notice that I've indexed the mu with an x. The exogenous state of nature is going to determine the mean. It's not going to influence the variance. That will make our lives much simpler. So let P be a vector of asset prices, and let R be the gross risk-free rate. Expected utility here is going to be mean variance. So what I'm going to maximize is the expected excess return minus a penalty, that's alpha, times the variance of my portfolio. One way to justify this is quadratic utility. But quadratic utility is a little crazy because it goes down. Another way to justify this is as the certainty equivalent of a Cara normal framework. A third way to justify it is the Campbell-Vissera approximation of a CRRA log normal framework. If you don't know what these words mean, this is sort of standard finance portfolio choice stuff. But we're about to take expectations. And taking expectations of certainty equivalence is a little bit weird. It introduces a preference for the early resolution of uncertainty. So if you go and you read the Van Nieuwenburg and Veldkamp paper, you'll see that they have strange preferences. Those preferences are designed to generate this kind of behavior. Okay, but let's not worry about that for a moment. Our prior over these mean payoffs is normally distributed. Our objective is linear quadratic in our action and the unknown state. And the prior is Gaussian. So we know in our rational inattention problem, if we use mutual information, or if we use the alternative that I've proposed, we will get actions and posteriors that are normally distributed. So let mu A be the mean and gamma be the variance-covariance matrix of our actions. I will tell you about a math trick that is true. It turns out that the value function in the rational inattention problem is just the expected value under the prior of the Lagrange multiplier. You can prove this pretty easily. But a consequence of that is that in the mutual information case, the value function can be written as a maximization over the pi a's of the expected value of the prior of the log of the expectation of e to the stuff. So this should remind you of cumulants and things like that. But I know that this pi a in the optimal solution to this problem is normally distributed. So as a consequence, we can write this maximization problem as a maximization over the mean and the variance covariance matrix, because those two things completely characterize a multivariate normal distribution. So I go from here to here by knowing that the solution to this thing is a multivariate normal. I have to define this gamma hat thing, which is sort of the denominator in the Bayesian updating. But it includes both the variance from my signal, or the precision of my signal, because it's an inverse, and the variance covariance matrix of this sort of risk that I can't learn about, this sigma in the payoffs. Because remember, all you can do in this setting is you can learn about the means. You can't actually learn about the realizations of the f's. This, by the way, is a common issue. I'll just sidestep it. In some rational inattention problems, you model it as if you could completely learn about the entire future. There's nothing that will ever happen that you couldn't, in theory, learn about. In other rational inattention problems, like this one, you put a limit on what it's possible to learn.
Isn't that just assuming a cost function?
Yeah, in some sense. But you will not hear it described that way. Both of those authors will say they use mutual information. So they might say they're using the same cost function, but in fact they're doing two different things. Because obviously what you really want to learn about is the f. You don't care about the mu. You want to learn about the f. But I'm not letting you learn about the f. You can only learn about the mu. So we have this lovely problem. So this first term, the log of the ratio of the determinants, plus this trace matrix, what is that telling us? It's telling us how much can I reduce my uncertainty. That is, how much can I match up my action to the expected returns. This second line kicks in when my prior is such that some assets are better than others. So the second line is all about, oh, even under my prior, some assets are better than others, so I should buy them more. The first thing is about the learning. But it's an ugly equation. But you can do some analysis. So you can solve it and generate mean and variance covariance matrices of portfolio choices. Just taking a step back. Observe why rational inattention is weird. The portfolio choice is your action. But what we're talking about it as a random statistical object with a mean and a variance covariance matrix. That's because we have in mind that you're getting a signal that is itself noisy and is inducing randomness in your action. So you have to get used to thinking about stuff like this. It turns out generically, the gamma, which is the variance covariance matrix of your action, will have rank 1. Take a step back and think about what that means. You could do all kinds of portfolios. But generically what you will do is buy more or less of one portfolio relative to the risk-free rate. That should remind you of the two-fund theorem. It should also remind you of the result I told you earlier about of Chris Sims, Mateka, and co-authors. Discrete actions despite infinite action spaces. This is still an infinite action, but your action is univariate normal, even though your action space is Rn. So there's something weird here. If you want a proof for the two-asset case, Mondria 2010 is a proof. I didn't write a proof here, but I believe it is true. So your action is always to choose the mean variance efficient portfolio given your posterior beliefs. And in general, you're just going to learn about one portfolio and then do that, more or less.
And you probably can't say anything about that portfolio at this level of generality, or?
Not without specifying something about the variance-covariance matrices. But it turns out that it is the I believe, now I'm really conjecturing here, but I believe it is the portfolio with the highest variance in its Sharpe ratio. Because when you think about it, what are you doing? You're getting a signal about whether to go long or short this thing. What do you want? You want that signal to be dispersed. You want it to be the case that sometimes you want to go long and sometimes you want it to go short. So at least in a very simple setting where everything is ex-ante equivalent, what you will do is choose the thing that has the most volatility of Sharpe ratio. Yeah.
But that's only a conjecture.
If I thought that I could publish a paper with that proof and nothing else, I would do the proof. But I have thus far figured out that fact and not figured out how to turn it into a paper. Because this Mondria paper basically does it for two assets.
I see. So Mondria gets the Sharpe ratio.
Yeah, and that's not how he characterizes it, but that's what I think he did. And I believe it generalizes to the n-asset case.
What's the result again?
So what you want to do is focus your learning on the portfolio that might be very good and might be very bad, where very good and very bad are determined by Sharpe ratios.
But the equilibrium is the market portfolio. That's for accounting reasons.
We haven't done anything with equilibrium here. So this is a single agent decision problem where we don't know what the mean expected returns on assets are. Now, you might make an argument in equilibrium that maybe everyone can't do that. But we'll add some noise traders or something like that to solve that problem.
It's still the case that the market portfolio is one portfolio in the frontier. One risky portfolio in the frontier. Everything into a mid-variance context.
That is not true. Or rather, once you have noise traders or someone else who is not doing this, then they will buy something. The rest of the stuff, which is not the market portfolio, can be the mean variance efficient portfolio. And so what you are doing is trying to figure out what that thing is. Van Nieuwerburg and Veldkamp, which is sort of the pioneering paper here, do not solve this problem that I've shown you. They solve a restricted version of the problem. So first off, they make the assets orthogonal. You can just rescale things. So you can say that that sigma matrix, the variance-covariance matrix of asset payoffs, is just the identity. They're going to make the variance-covariance matrix of your prior diagonal. And then they're going to require you to learn in a diagonal way.
That's like making each problem separate almost.
Exactly. It makes each problem into a single-dimensional linear quadratic Gaussian rational inattention problem. And you can then just solve them separately, but then you can think about the attention allocation across these different problems, because there is this master level attention allocation. And what they show is that, at least with mutual information, it is optimal to learn only about one asset. You may end up holding other assets for diversification purposes, but you will not learn about one asset. And what asset will you learn about? The one for whom the variance of the Sharpe ratio is the largest. Right? Because you want to learn about something that maybe you should buy and maybe you should sell. Right? If you knew you should buy it or knew you should sell it, there would be no information to learn. However, there is a second thing going on in these papers that you need to be aware of. And this relates to a comment that I made much earlier about the early resolution of uncertainty. Because these agents have a preference for the early resolution of uncertainty, even if they were forced to hold a particular portfolio, there was no action to be chosen, they would still like to learn about that portfolio's returns so that they can resolve uncertainty. So that extra motivation is present in these models, sort of. What do I mean, sort of? We have mean variance portfolio choice. If you have quadratic utility, that's expected utility. It's not a certainty equivalent. There's no early resolution preference. If you got your mean variance portfolio choice from Cara normal, then there is a preference for the early resolution of uncertainty because we're looking at that certainty equivalent. So if you see stuff in these papers like log of expectation of E to the final wealth, that's what's going on. Okay. In the previous problem, we took the prices as given. But in a market setting, where other people are also learning things and then buying or selling, the prices will have information in them. And so we would like to learn also about prices. So we're going to assume IID noise across agents. I think in this context that this is a bad assumption. Casual empiricism leads me to think that sometimes in financial markets, agents collectively get bad signals about an asset, becoming either overly enthusiastic or less enthusiastic. This IID thing is not going to allow for that. But the mu A with IID, the mu A in our optimal policy is going to determine asset demand given prices and prior. Right? We don't need to worry about the variance-covariance matrix. Doesn't matter because of the IID. The mean is all we care about. The prices must clear the market given supply. We're going to add noise traders for the usual reasons. Otherwise, the price will fully reveal the information, and everyone will hold the market portfolio. Consequently, we're going to think of the prices as another signal. The Van Nieuwenburg and Veldkamp paper and Mondria and everything that has followed them, as far as I can tell, assumes that the signal embedded in the prices is observed for free. So when they solve the rational inattention problem, the prior that the rationally inattentive agent has is the posterior associated with after you've observed prices and done your Bayesian updating. It's not clear to me that this is the right assumption. And so I think this is an interesting area for future research.
I want to understand the timing is a little crazy this way, right? So first you observe the equilibrium price, and then you're going to learn about the signal, or the two signals you want.
And then submit your demands, and that has to determine the equilibrium price.
Which has to be equal to the one that you...
Yeah, so probably to make this all make sense, you have to do these Denty type things again.
Yeah.
People in this portfolio choice literature have not thought about that issue. Denty was very careful in the context of his game. I've not seen a justification for what you're talking about in this context, but I think something like what Denty did is possible. This all works out because it turns out that the prices are also normally distributed. provided that these noise trader demands are normally distributed. You just got to keep everything Gaussian, and it's all going to make sense. Okay, so how are we doing? Okay, great. We have 15 minutes. Looks like I am, again, on course to end a little bit early, but I'm happy to take questions. But in the last bit, I'd like to tell you a little bit about what Jay Lee, who was one of our PhD students who was on the job market this year, did that's sort of related to this Van Nieuwenberg and Veldkamp stuff. And it's mostly an empirical paper, but it's motivated by a modified version of the Van Nieuwenberg and Veldkamp model. So here, there's only going to be one asset, one risky asset and a risk-free asset. So it's not the n assets. But that asset is going to be exposed to k risk factors. So the payoff of an asset in state x is going to be a sum over the k risk factors of the asset's beta and the x's associated with that factor. And now x here is an RK object. So, in finance, we often talk about factor models. This is where that's coming from. You might have FAMA French, right? Market, value, SMB, 3 factors, that would be the little x's whose returns, and then everything else has betas to those factors that determines their returns. Traders are risk neutral, but pay a transaction cost that is quadratic the more they buy or sell of this asset. Quadratic transaction costs, risk-neutral payoffs, is yet another way of getting to linear quadratic Gaussian. So this is more of a market microstructure kind of way of doing things, rather than a portfolio choice asset allocation kind of way of doing things. But they're all engineered to be linear quadratic Gaussian. Our prior is we're just going to set all these means to 0. I don't want to deal with the means. And we're going to have a variance-covariance matrix on these factors. We're going to do the Van Nieuwenberg-Veldkamp thing. So signals for different risk factors cannot be correlated. What you would like to do in this setting is get a signal that is sort of about some linear combination of the risk factors, in particular this linear combination. But you can't do that. You can just get one or the other, or some amount of both. It's clearly suboptimal in this setting. Then there's going to be linear price impact. So we're not going to have noise traders, although you could microfound this with some Gaussian noise traders. But it's just going to be the more these guys buy, the higher the price, in a way that is determined by this lambda price impact parameter. So this is obviously more of like a market microstructure, like Kyle model type thing, but similar idea.
How model has noise trader.
Yeah, and it ends up.
Price impact is a result of the.
Yeah, exactly. And so he has an appendix where he does the full thing. Yeah. Okay, so solving the model. Well, here we only have one action A, right? But imagine for a moment we had this A tilde, which was the amount of each factor that we wanted to buy, hypothetically. It turns out that we could write our A our utility function, instead of being as A, as being about A tilde, by sticking a bunch of these vectors of 1s in there. And then we observe immediately, oh, this is exactly the same as our previous model, but now our variance-covariance matrices have rank 1. The variance-covariance matrix of our prior, the variance-covariance matrix of the uncertain payoffs are all rank 1. Consequently, with mutual information, we know as a result of what we've already shown that you will get complete specialization. What does that mean in this context? It means you will completely pay attention to one factor and ignore all the others. Van Nieuwenberg-Veldkamp 2010 and J use a slightly different cost function, not mutual information, where costs are linear in precision for normal distributions. I will point out, this is not really rational inattention. The reason that we could reduce things to normal distributions was that we assumed mutual information. When you go and change the cost function, but you keep things normal, you're giving them suboptimal signals. Set that issue aside. If you assume linear in precision, instead of complete specialization, you get partial specialization. You pay more attention to the things that are more important, less attention to the things that are less important, and maybe no attention to some things. So
I'm sorry. I always get confused when you're giving them, when you say something like you're giving them suboptimal signals, it's as though the other signals are too costly to use. So it does fall in.
If it gets out of the cost, it isn't funny. You're right, but it's like you using this log ratio, right, of the probabilities. That's a frame you're at. So
If you insist that cost function
Yeah.
apply everywhere, then
what
yes, that.
But what you propose is that you make some infinite, and the rest you do.
yeah, exactly. And that would be a cost function. Yeah, okay, fair enough. Yeah, so that would justify this. The equilibrium here is that the price of this good is going to be a linear combination of the true factors that actually occur, because people are learning about these things. They're getting incorporated into prices, but not completely. This D is a number that is not 0. If D were 0, the price would be equal to its fundamental value. D is not 0. It's always bounded between something bigger than 0 and 1. The thing that is bigger than 0 is like the price impact monopoly intuition. You like don't sell everything so that you can get some advantage from your information. This sort of intuition exists in Kyle. But D being bigger than that is due to the rational inattention. And in particular, for the factors that matter most, you'll be at the Kyle end of this. And for the factors that are almost totally unimportant for the asset payoff, you'll be at the 1 end of this. And remember, with mutual information, everything is this or this.
If you go back to the Kyle story, the reason you have a price impact, because there is a market maker who is kind of knows that you're informed.
Or is worried that you're informed.
There are market makers that, they know they're informed people. And then the competition, depending on
Yep.
the version you take, competition drives a certain price impact. So choice a certain price. Now, if you put a market maker here, you know that people are not, even the so-called informed people,
No, but remember,
with less information.
the informed people know something about X, which is better than what the noise guys know, which is nothing.
Yes, but if they know better, wouldn't their price impact be small? I mean, shouldn't
Yeah,
the market makers say, okay, those guys don't know very much?
No, but your intuition about the Kyle model, the Kyle model does not rely on the informed trader knowing perfectly the fundamental.
I understand that.
And that's all that's going on here.
Well, that's protection. The market maker protects himself.
That's right. So now,
Who's
and that's where you derive the price impact for. Here the price impact is exogenous before you solve the irrational attention model.
Well, but so in the appendix,
The lambda
yeah.
should be a function
Yeah,
of these decays.
you're absolutely right. So in the appendix where he does that, the lambda is endogenous to this.
Yeah, and that would...
But for our purposes, that issue is not important because it's not 0. Your price impact is not 0, and that's really all we need. Okay, so what do you get out of this? Well, Sims 2006 and Koibian-Gorodnichenko emphasize underreaction, and Jay's model delivers the same kind of thing. So when they get the signals, that's when the price is being formed. The xi's, he uses a big X. My notation had a little x, so I apologize. Is such that there's a true xi but we don't get the full impact because of this D thing. And then, of course, we will get later the full impact. So this suggests an empirical specification. Let's find an event where we think that the x has changed. Let's run a regression on the immediate impact, and then let's run another regression on the final impact, like much later, and ask how much of the final impact is incorporated in the immediate impact.
We know that price earnings announcements behave like this.
Exactly.
You don't have to.
And the D is going to be the measure of that. And remember what our theory says, our rational inattention theory. It says D is small, this thing will be tiny, if it's very important. D will be very big if it's not very important. And that's the key insight that he's going to test. So remember, D small if it's important, D big if it's not important. Okay, so here is some data. So what are these? It's data on investment grade and high yield bonds, data, corporate bonds in the US that you can get from something called Trace. And it's looking at changes, so these are corporate bonds, there's a corresponding stock. It's looking at changes in stock prices and changes in risk-free interest rates and asking how quickly those get incorporated into bond prices. So the shock is either a change in the stock price or a change in the interest rate. And we're asking how quickly does it get incorporated. Now, investment grade bonds are from companies that are not very likely to default. And consequently, their bonds are not very sensitive to equity valuations. That's the intuition of the Merton model, right? The bonds have a low delta. High yield bonds are from companies that are much more likely to default. High yield bonds are much more sensitive to equity valuations. The reverse is true about interest rates. High yield bonds, at least as a percentage of the price, are relatively insensitive to interest rates. Whereas investment grade bonds, think about a AAA bond, that's basically like a treasury. It's extremely sensitive to interest rates. So what happens with an interest rate shock? Interest rates change all of a sudden. Well, it turns out that the investment grade bonds incorporate that information extremely quickly. It turns out that you cannot make money trading investment grade bonds by looking at the treasury market, seeing interest rate changes, and trying to race to the corporate bond market and take advantage. Someone is doing that arbitrage very efficiently already. The high yield bonds, on the other hand, which are much less sensitive to the interest rates, seem not to incorporate the information. Maybe the high yield bond market is inefficient, or the traders are stupid, or there's illiquidity, or search and matching. You can tell those stories for why this information is slowly incorporated. But then you have to go to this graph. Here's the response to the equity shocks. High yield bonds are very sensitive to equity shocks. The high yield bond traders understand that high yield bonds might become equity very soon, and so they look at equity prices. The investment grade bonds are slower at incorporating equity shocks. So it's almost as if the high yield bond traders understand that they should pay attention to the stock market, but can ignore the treasury market. Whereas the investment grade bond traders understand that they should pay attention to the treasury market, but can ignore the stock market. And that's what the data look like. So I think this is a very cool demonstration of a phenomena that I find very hard to explain without reference to rational inattention. First off, it's clearly inattention. The information is not fully incorporated immediately. But second, it's rational. the most important information is incorporated quickly, whereas the less important information is incorporated slowly. So to conclude, I think we're on time, information is really central to finance. Almost everything in finance is about who has information, who doesn't, how it gets incorporated into prices, and related questions. Rational inattention models offer us an opportunity to think harder about information and its relationship to finance. Information doesn't just fall from the sky. Someone has to go out and acquire it and think about it. And the incentives to acquire information and process it depend on the equilibrium, which is itself determined by what information people have. So you can model this interplay in a great way, I think, using rational inattention. And so great progress has been made, I think, especially on the theory side in recent years. But I think there are many opportunities and unanswered questions for applying rational inattention theory in finance. And I hope that some of you will consider working on that. So thanks for listening, and that's that.